I've been investing $25 to $30 every single week since May of 2019. It's helped transform my dividend portfolio from one that paid me a little under $80 within my first full year of investing to one that's paid me almost $100 within the past 4 months. Throughout the past 5 years, I've definitely had a lot of financial success, but I've also had the same amount, if not more, financial failures. But if you guys watch this video, it will help you avoid all the financial mistakes that I made over the past 5 years. Aside from the money, which I'll get into that in a second, not knowing what to invest into and being really afraid of the research that I would have to make the right investment is what kept me from pulling the trigger in the stock market in the first place. But getting over that was a lot easier once I realized that a lot of the companies that are part of our everyday lives make up some of the best stocks when it comes to long-term profit and long-term passive income. There are companies like Home Depot, Starbucks, McDonald's, and Apple that are not only some of the most popular companies in the entire world, but they have two really cool things in common. They each have a share price growth of over 100% within the past 10 years, and within the past 10 years, they've each paid and increased their dividend payouts to their shareholders. Investing in what you know can make building your portfolio from the ground up a lot easier, because not only does it get you the opportunity to start sooner, but it also allows you to invest into positions that you're pretty comfortable with, so you don't have to focus on the research right out the gate. Plus, when you start seeing that growth and you start receiving those passive incomes over time, you can then use that time simultaneously to do the additional research just to prepare for future investments. After completing my first full year of dividend investing and getting that really big check, all $77 of it, I was willing to do whatever I could to make sure I was getting more within the next month or the following year. But I started falling for what I eventually learned to be called the dividend yield trap. And that was because the yield was all I cared about. The higher the yield, the more I was going to get paid every single month or quarter, or that's at least what I thought. There are a lot of high dividend yielding companies out there, and unless they are categorized as something called a REIT, then the likelihood that they're going to keep that high dividend yield and high payout is pretty slim. For example, there's a really popular company called General Motors, which is a publicly traded stock. And back in the early 2000s, it had a dividend yield of over 10%, meaning it was paying its shareholders at the time a little over 50 cents every single quarter. But unfortunately, the reason why the yield was so high and increasing is because the payout stayed the same, but the share price of the company would drop by almost $40 over the course of a couple of years. And because of a lack of recovery, that resulted in the company cutting its dividend in half and then cutting it completely and then going bankrupt, and every shareholder within GM at the time didn't receive anything after the bankruptcy. So it really sucked. Because of their situation, that ended up being a company that was taking more of its money and giving it to the shareholders rather than keeping it to themselves. And you really don't want a company that does that. At best, as you get more experience, at least have some type of strategy to where you're implementing certain high yielding stocks or ETFs into your portfolio, knowing they're not going to provide long-term profit growth. Speaking of which, if you're really trying to provide long-term wealth for yourself, then passive income should only be half of the equation. For example, realty income, it's one of my favorite dividend paying positions, not only because it pays me dividends every single month, but has been paying those dividends every single month for the past 30 years, including 26 consistent years of increasing those dividends. But as of recent, its stock growth history isn't necessarily the greatest. And then on the other hand, you have a company like Nvidia, which its dividend is pretty trash. It pays, I believe, like 40 cents per share every single year. And with a share price of a little over $1,000 at the moment, that kind of sucks as far as a dividend paying position. But again, this company has a share price of a little over $1,000 a share, which is based off an over 2,000% increase over the past 10 years, including over 200% increase over the past year. For me, realty income is one of my top dividend payers every single year, and Nvidia is the company that's brought me the most profit since I started investing to begin with by like miles. So if you can have a portfolio that's a nice blend of dividend and stock growth, the long-term profits can be crazy. One of the scariest times for me as an investor was definitely the entire year of 2020 after the stock market just plummeted based off the impacts that the pandemic had. I was at a point where I had no idea what I wanted to do with my portfolio. I was reading a lot of articles that are having conflicting arguments, whether it was you should keep your stocks in your portfolio and keep investing, or you should pull out before it's too late. That for me was just a really huge reminder that whether it is an internal or an external situation, share prices can be very volatile whether they increase or decrease. And I think what makes it a lot easier, shout out to my previous advice, by investing in what you understand that regardless of what happens, you know what the company does and you can still have hopes for them. That's just a simple way of saying to try to keep emotion out of investing. And it's way easier said than done because I was definitely freaking out even though I decided to keep my shares in my portfolio during the entire situation. But luckily it worked out for me. The purpose of investing in the stock market should be to continue or to start building generational wealth. But you don't need generational wealth to start investing in the stock market. For years, I honestly didn't think that I had enough money to invest in the stock market, which is probably why I didn't start investing until I was 26 years old. And even now, I'm only investing $30 a week, which a lot of you guys might feel like is not a lot of money at all. Again, that $25 to $30 a week took my portfolio from producing a little under $80 from its first year to a portfolio that's producing over $200 as of last year. Regardless of what you have to invest, if you're able to budget a few dollars over to the side, then definitely do that. And one thing that's helped motivate me to continue investing no matter how much money I have is actually tracking my progress. So I have charts that show me how much money I've made every single month over the course of a couple of years, and comparing it and seeing that growth continues to motivate me while I do my best to budget more money to invest even more. I promise you, you will thank yourself later on. I definitely wish I would have taken more advice like this. It probably would have kept me from going crazy during the tough times, and more than likely it would have helped me invest earlier in my life rather than in my late 20s, which would have probably made me more money in the long term. But regardless, even though I'm coming up with this advice now, I'm really happy where this has taken me over the past 5 years, and hopefully this advice helps you as well. But bonus advice, it's always really great when you can find dividend paying stocks at a discounted price. And I actually talk about a few in this video that are very discounted. I mean, they are near their 52-week share price low, but they all have two things in common. They have long-term dividend payout history and long-term share price growth history. So make sure you check that out. Hopefully you guys enjoyed this video, and until next time, as always, take care.